Today, we will figure out how to stake your Bitcoin, Ethereum, or stablecoins at a 30% annual rate, so much higher APYs compared to the conventional staking, and what risks are involved in staking with such high APYs. To do this, we will make use of options and see what they are and learn how they work and when to use them. My name is Nick, you're watching the Cryptus channel, and let's start. To make use of options, let's head over to the decentralized platform Polysynth as an example. Polysynth allows us to trade synthetic assets and do marginal trading in a decentralized manner without KYC, straight on the blockchain. And they have also recently launched a platform with option vaults, and here you can get or earn 13 to 46% interest rates for staking Bitcoin, Ethereum, and stablecoins. So this yield is quite high compared to traditional staking or even farming of stablecoins, where you at this point of market earn like 2 to 3% annually. So how can you possibly make such high returns here, and what are the risks involved? In order to see them, we need to understand how options are working and what they are, what they do, and we will do this exactly in 1 minute. Also, don't forget to subscribe to our channel so you don't miss out on awesome investment strategies during the bear market, and consider subscribing to our Twitter to get even more infos about great projects and new gems, because not everything goes here on our YouTube channel. I would really appreciate it. Thank you. Understanding options is going to help you both in the crypto markets, also in the traditional finance area, because options as such are a really universal instrument and they can work anywhere, not only on the platform we're going to talk about today. As a short explanation of an option contract, it's basically a financial contract that gives the owner a right to buy, but doesn't oblige him to, buy a certain asset for a certain price at a certain period of time, or a certain time. And the condition is that the option buyer pays a premium fee to the seller of the option for the opportunity to execute or not execute the option. An option contract consists of an option's expiration time, an underlying asset, the quantity of these underlying assets inside the contract, and a price for these assets. And we can create ourselves an option and sell this contract, or we can buy an option contract from the person who basically created it. And options come in two main types: a call option that gives the buyer the right to buy an asset from the option seller, and a put option that gives the buyer the right to sell the asset to the basically option seller or issuer. And both are carried out at basically a given time and price that is stated in the contract, regardless of the current market price of the asset. Options do have a lot in common with futures, but the difference is that in future contracts you're obliged to buy or sell the assets inside the contract, but with options you can back out on it. So that special privilege of being able to cancel the deal or not going on the deal described in the option contract is basically what makes the premium fee for this option contract much higher than the premium fee in the futures contract. And maybe it sounds complicated, but let me give you an example and you'll understand everything like literally in a minute. Let's first look at the call option. There are always two people involved in trading and executing the option: person A that releases or sells the option, and person B that buys the option and later decides whether he wants to execute and use it or not. As an example of an option, say you are person B and you have acquired or bought a call option from person A to buy Bitcoin for $22,000 in a period of 7 days from now. In order to get this option, you have paid the person A $1,000 as a premium, which he gets to keep in any case, if you do buy the Bitcoin or even if you don't buy the Bitcoin. And also, as a side note, let's say that Bitcoin at this time on the market price is $20,000. So now if Bitcoin goes, for example, up, let's say to $25,000 in 1 week's time, so the time in the option, person B will be able to enjoy the right of buying Bitcoin for $22,000 from person A, because the option grants him the right to do so. And then, having bought Bitcoin for such a price, for $22,000 like in the option, you can sell, or the person B can sell the Bitcoin immediately at the market price of $25,000 and make instant profits. So the perfect scenario for the buyer of a call option is when the market price of the underlying asset goes higher than the price in the option, because they could benefit from buying the underlying asset cheaper from person A, from the person who sold the option, and then basically resell it higher on the current market prices. On the other side, if Bitcoin stays below or at $22,000 as listed in the option, then the option gets unprofitable for person B, for the buyer of the option, and he will not execute the option because he can buy the Bitcoin cheaper on the market anyway, or the same price. So why would you buy something or execute the purchase of something that can be obtained on a lower market price and can be resold higher anyway? Also remember that person B that bought the option has paid person A, the owner of the underlying asset and the one who issued the option, a certain premium fee for being able to use or not to use the option. In our case, this was a fee or a premium of $1,000 that we just brought up as an example, so you can easily remember it. And that will be person A's unconditional gain, regardless if he has to sell his Bitcoin or not. And the perfect scenario for the seller, so basically for person A, is when the market price for the underlying assets goes lower than the option price, which makes it unprofitable for person B to use the option, and so the seller or person A keeps his assets unsold and he earns the unconditional premium, which is how they, person A, will basically make their profits. So let's recap, and basically there are two possibilities or outcomes for this type of call option. In the first outcome possibility, by the expiration time of the option, Bitcoin's market price is above $22,000, let's say at $25,000. And in that case, person A sells his Bitcoin to person B as stated in the option contract for $22,000. Person A, on the other hand, receives $1,000 as a fee, but misses out on selling their asset for $25,000. And since they're selling it for $22,000 already by the contract, but could have sold it to $25,000. Thus, person A is down $2,000, considering that they got the $1,000 premium fee, but lose on $3,000 profit. On the other hand, person B, he makes a profit of $2,000 because they buy the Bitcoin at $22,000 and sell it immediately for $25,000, making $3,000 profits, but also paying $1,000 premium to person A. So this scenario will be profitable for person B, but basically a loss for person A. The second outcome is that by the expiration time of the option, Bitcoin's market price is at or lower $22,000. And in this case, the option buyer, person B, loses money because he cannot buy this asset and resell it higher at the market because, well, obviously the market price is lower than $22,000. And he also pays the $1,000 fee to person A. Thus, person B loses $1,000 and person A earns these $1,000. Also, person B doesn't execute this option since, again, he wouldn't make any profits. And in this case, person A keeps his assets that he brought previously, so basically Bitcoin, and tops that with the premium that he basically obtains. And this is how options allow speculating on the potential asset price while also spending less money on the trade, because the option buyer pays only the premium rather than buying the whole underlying asset by itself. In our case, the buyer, person B, has spent only $1,000 on the premiums rather than spending $20,000 for buying Bitcoin basically as a whole asset. Now you might think, is there actually a way to speculate the other way around, basically thinking that the market price of the asset will go down? And certainly there is, and this is the put option. A put option is a contract which allows person B, so the buyer of the option, to sell an asset at a fixed price. Thus, person A is obliged to buy it from person B if he wants to sell. For example, Bitcoin's price is now again $20,000, as in the previous example. Person A sells an option saying they would buy a Bitcoin from the option buyer, so basically person B, for $18,000 in 1 week, regardless of the market price. So person B, thinking that Bitcoin will fall below $18,000, purchases this options and again for the same hypothetical $1,000 premium. If now in 1 week's time Bitcoin falls, say, to $16,000, then person B, the option buyer, can buy the Bitcoin from the market at the price of $16,000 and sell it immediately to buy the option for $18,000, which is how they make $1,000 clean, because they earn $2,000 from reselling Bitcoin, buying it on the market, selling it then to the option issuer, and but they have previously paid the $1,000 premiums, which again, $2,000 minus $1,000 is $1,000 clean. But again, in case of the Bitcoin's price being equal or higher than $18,000 at the expiration time of the option, person B doesn't use his right to execute the option, since he won't be able to buy Bitcoin lower than the option price and resell it for an immediate profit. So he just loses his $1,000 as a premium that person A gets as a profit that person B paid before. So this is how options work and how they let you earn by investing less money if you're right on the market direction. This is really important. And instead of buying the whole asset with the intention of a subsequent sale, you can just purchase an option and make more profit given a lower amount of investment for the option price or the premium, rather than buying the whole underlying asset by itself. But the risks with options are of course higher too than compared to traditional spot trading, because by losing on an option you lose your funds and you don't get any assets, because you just spend your money or the funds on buying or on paying basically the premium fee. Whereas if you would have just bought the Bitcoin, you would still have the underlying assets or the Bitcoin, the coins by themselves, waiting them to go up in price basically later, so you could just have hold them and sell them off later. And with options this is not the case, because you either gain or you lose, and if you lose you don't get anything in return, you just pay the premium fee. So this is basically like a trade-off of higher risks but also higher possible profits. To summarize, here is a short instruction on options. You should buy a call option when you think that an asset's price will grow. You should sell or release basically a call option when you think that the underlying asset's price will stay the same or fall. Then you should buy a put option when you think that the underlying asset's price will fall, or you should sell or release a put option when you think that an underlying asset's price will stay the same or grow. And that's actually what Polysynth allows us to do, basically to release or sell a week-long call or put option for Bitcoin and Ethereum, and basically hold these assets or stablecoins if we are making put options, while still making annual percentage yields from the money that people lose on buying our put and or call option, and basically paying us the premium fee. So let's go more into detail. We can use basically covered call options for Bitcoin and Ethereum and covered put options for, again, Bitcoin and Ethereum, but Polysynth is also promising that they will add some more higher riskier assets later to the platform. So if you're watching this video a little bit later in time, you can go and head over there and basically look what other options are available here. But nevertheless, let's see exactly what the risks are here and how much we can actually earn and how do we start earning. Basically, the thing that's interesting for us, for me, it's personally right now Ethereum cash covered put options. So me thinking that Ethereum will not go below a certain threshold right now on the market, but would rather stay the same or maybe go up. So what we can earn here is a projected APY of 38.8%, and I will tell you how this is calculated in a second. So just let us head over to the tab or to the vault here down below. So the way Polysynth or their vaults work is basically we have to deposit our underlying asset, because this asset will be then used to purchase Ethereum if it falls below basically $700. Sorry. And this means basically that we're creating or selling this put option. Another person can buy the option if he thinks that Ethereum will go below $700, and basically then buy Ethereum for less than $700 and sell this Ethereum for $700 basically for us. And if this happens, then our stablecoins will be used to again buy the Ethereum for $700. What does this mean? The worst case scenario, how much can we lose? Well, basically anywhere from 0 to endless, depending on how far below $700 Ethereum would fall. Let me bring you an example. Let's say Ethereum stays at or over $700, then we don't lose anything. We basically just get our profits, which is listed here as the premium fee. And because the split between the current price and basically the strike price is really high, even for crypto, the profit is not as high. So these are more the safer vaults that are launched right now. This is why it's only like 38%. This means, again, if Ethereum is over $700, we don't lose anything. But if Ethereum on the market falls, let's say, to $600, then basically the option buyer will be able to buy Ethereum again for $600 on the market and sell it to us for $700. And this means we will get $100 loss for every $700 we put into the wall. Meaning, again, for example, if Ethereum falls really to $600, then we will lose about 15% on this wall and this week. If Ethereum falls, for example, to $500, which I don't know how likely this is, pretty unlikely in 1 week's time, then basically we would lose anywhere around a little less than 30%, and almost 30%, because the option buyer would be able to buy the Ethereum for $500 and sell this Ethereum to us at $700, which we will be obliged to buy. And this is also the same thing for the covered call options, where we think that, again, the coins will rather stay the same or fall, but not grow. Let's take, again, Ethereum covered call as an example. So the strike price here is, for example, $1,300. So right now Ethereum costs at the market price $1,150. So we think that Ethereum won't grow higher than $1,300. If it does, then basically we're obliged to sell our Ethereum for the price of $1,300. So we won't really lose anything, but we won't get the profits that basically we would have gotten if we would just hold our Ethereum. So basically, here we need to deposit not the stablecoin but the Ethereum itself, and this actually means that right now Ethereum costs $1,150. If it goes over $1,300, let's say, to $1,400, then what is going to happen is we're just selling our Ethereum at the price of $1,300. And yeah, the person could then resell it even higher at the market at the same time for $1,400. And this is basically how it works. But let's get back to the Ethereum cash covered put option. And basically, I will show you how you can deposit your stablecoins to the vault to get basically these higher percentage yields than on traditional staking or farming. But again, before we do this, let's just look at the projected APY. So this is not APR, this is APY. So the cash is always reinvested weekly, but every week we can take our investment basically back out if we want to. So this APY is calculated on how much we will get returns in 1 year based on the performance of the last 4 weeks, because the vaults are running for about like only 4 weeks. So basically not that much of the time. So you can see the past performance here. But of course, the past never dictates the future, so we need to use our own basically head and think if we're doing the correct thing with the correct option vault or not. But still, again, the threshold between the market price and the strike price is again pretty high. So basically, if you deposit your stablecoins again here to the Ethereum put, you will not earn in 1 week these 38%. You will earn, you can calculate it by yourself, 7 divided by 365 times this annual percentage yield. This is how much you would basically earn from 1 year. So what you do is you just deposit your stablecoins here, and then you let them spin through if you want to. And if at some point of time you feel like you want to exit the pool because you worry about the market, you don't want to be in the market right now, you can just basically withdraw your stablecoins plus the profits you've gotten over the period of time, and basically be safe out of the vault if you're worried. So how to deposit it? You just connect your MetaMask on Polygon. You need the coins that are being used in the pool, so it's either Bitcoin or Ethereum, or for our pool it's USDC, because you would use the USDC to buy out the Ethereum at the strike price. And basically I already have the USDC on my MetaMask on Polygon. In order to put the coins on MetaMask on Polygon, you can either withdraw it from Binance or Coinbase or any other exchange on the Polygon network, or you can basically, if you have any other coins on the Polygon network, like a Nomadic or anything other, you can just use the 1-inch DEX to trade them to the correct coin there. So what can you do? Basically, you type in the amount you want to invest. Just as an example, we'll type in $100, and basically we'll just click on deposit USDC. Then we need to confirm our transaction in the MetaMask. Just 1 second for it to load. We're confirming it, and bam, that's it. Basically, in a couple of seconds, our deposit will be complete. So right now we're good. We have deposited our 100 USDC to the pool, and basically right now they didn't start to work yet. They will only start in 1 day and 21 hours. So basically every Friday, because because this is a weekly put and call options, and this Friday we won't earn anything because our money is just prepared to launch on the next weekly cycle. So if you want to withdraw or exit the pool, you've got two options. Basically, if the next Friday didn't start yet, like in our, like for example, in our case right now, we can just click here on instant withdrawal and click max. And if we've basically changed our mind, we just take out our coins. But if the next Friday hits and basically our options are being sold to the person BA, to the buyer of the options, we need to use the standard withdrawal. So basically we type in the amount we want to withdraw, and this is a two-step withdrawal. First of all, we send basically a notification to Polysend that we don't want to be active in the next cycle anymore. So basically our money will be still in the pool until the next Friday, until the expiration of the options, and basically then we can do again the instant withdrawal and when our USDCs or Ethereum Bitcoins are unlocked. And this is how simple it is. So basically now you understand how much you can earn on Polysend, how much APY, and so why you should or could consider staking on here, because you can earn much more. But also please consider the risks that if some really terrible event on the crypto market happens, then and the price of our underlying assets go below the strike price, we can lose a really sometimes big, sometimes a small amount, but this is not risk-free staking. So there is a possibility to lose. Well, so today you've earned how options work, when it's reasonable to buy an option or to sell an option, and what type of call or put option to use. These rules are as eligible for crypto, so also for traditional financial markets. So this is something new I hope you've learned today. And also you have learned how to use option wallets in crypto using Polysend, basically how much you can earn, what the risks are, and basically the mechanics of using platforms as Polysend or like Polysend. So in the end, I just want to say I hope this video was helpful, interesting for you, and that again you've learned something new. This will be really great, and please consider subscribing to the channel if you enjoyed this video. I will be really thankful for this. And yeah, we'll see each other in the next videos. Thank you again for watching, and have an awesome week. Bye bye.